Wondering how the Fed's upcoming rate cuts could impact your mortgage? Today, we're diving into what lower Fed rates mean for you as a home buyer and how you can take advantage of this shift to save big on your mortgage. Stay tuned until the end because I'll be sharing key strategies on when to lock in your rate and how to make the most of these changes. Welcome to Mastering Mortgages with Yatin, where we turn complex mortgage topics into simple, actionable advice. I'm Yatin Karnik, and if you want to make smart home buying decisions in today's market, you're in the right place. Let's get started and break down how these Fed rate cuts will really affect your mortgage and what you should do next. In this video, you'll learn the crucial differences between Fed interest rates and mortgage rates and why they matter for home buyers. Did you know that a small change in the Fed's interest rates could impact your mortgage payments by hundreds of dollars? For example, just a 0.25% reduction in interest rate on a $400,000 loan could reduce your monthly payment by approximately $65. That's over $700 a year. Understanding these impacts can help you make more informed decisions about when to lock in your mortgage rate. Coming up, I'll show you how to time your rate lock to get the best deal. But first, let's break down two key concepts: the Fed funds rate and mortgage rates, so you'll know exactly how these decisions impact your finances. First, federal interest rates. This is the interest rate at which banks lend money to each other overnight. Set by the Federal Reserve, it's a primary tool for managing the economy. Changes in the federal funds rate influence the overall economic climate, including borrowing costs. This ripple effect extends to various interest rates across the economy, including mortgage rates. Next, mortgage rates. These are the interest rates you pay on your home loan. While influenced by the federal funds rate, mortgage rates are also affected by other factors, such as inflation and market conditions. Your mortgage rate determines your monthly payment. Even small fluctuations can significantly impact your monthly budget and the total cost of your loan over time. Understanding these two rates will give you a solid foundation for grasping how they interact and what it means for you as a home buyer. Many home buyers are confused about how the Federal Reserve's decisions influence mortgage rates, leading to misconceptions and poor financial decisions. This confusion often stems from a lack of understanding of how the Federal Reserve sets interest rates or how those rates impact the housing market. Additionally, many people believe that the Federal Reserve directly controls mortgage rates, which isn't entirely accurate. This misconception can result in decisions based on incomplete information, ultimately costing you time and money. In reality, the relationship between Fed interest rates and mortgage rates is more complex, with multiple factors at play. Misunderstanding this relationship can lead to higher borrowing costs, reduced credit availability, and decreased housing affordability, potentially putting your dream home out of reach. That's why getting this right is so important. The lack of clarity around Fed interest rates and mortgage rates is a major pain point for home buyers, one that can have a lasting impact on their financial well-being. It's essential for home buyers to develop a clear understanding of how these rates interact and influence the housing market. By doing so, you can make more informed decisions, avoid costly mistakes, and ultimately achieve your goal of owning a home. The Federal Reserve, the Central Bank of the United States, is responsible for setting interest rates to promote maximum employment and price stability. To achieve these goals, the Fed uses various tools, including the federal funds rate. This rate has a ripple effect, influencing the broader economy and ultimately impacting mortgage rates. When the Fed lowers interest rates, it injects liquidity into the economy, making borrowing cheaper and increasing consumer spending. This boost in economic activity can lead to higher inflation, as more money chases a constant amount of goods and services. In response, the Fed may raise interest rates to combat inflation, reducing borrowing and slowing down the economy. Mortgage rates, in turn, influenced by these economic conditions, including inflation, economic growth, and the overall health of the housing market. The relationship between Fed interest rates and mortgage rates is complex, with multiple factors at play. While the Fed's decisions don't directly control mortgage rates, they do influence the overall direction of interest rates, which in turn affect mortgage rates. For example, when the Fed lowers interest rates, mortgage rates may also decrease, making borrowing cheaper for homebuyers. That's why timing your mortgage decisions with these rate movements can be a game changer. However, if the economy starts to overheat, the Fed may raise interest rates, leading to higher mortgage rates and increased borrowing costs. Over the past decade, the federal funds rate has experienced significant fluctuations. Following the 2008 financial crisis, the Fed maintained historically low rates to stimulate the economy, reaching near zero levels by 2015. However, the onset of the COVID-19 pandemic in early 2020 prompted the Fed to rapidly cut rates back to near zero to support the economy during the crisis. As the economy began to recover, the Fed initially kept rates low to foster growth. It wasn't until 2022 that the Fed enacted more aggressive rate hikes in response to rising inflation, bringing rates to levels not seen in years. This period of rising rates marks a notable shift from the prolonged low-rate environment that characterized the post-crisis years. During this time, mortgage rates have followed a somewhat parallel but not identical trajectory. Initially, when the Fed cut rates during the 2008 financial crisis and later in response to COVID-19, mortgage rates also decreased, making borrowing more affordable. However, unlike the federal funds rate, mortgage rates did not always move in lockstep. For example, mortgage rates remained relatively low after 2015 despite the Fed's gradual rate hikes, due in part to other economic factors like inflation expectations and global economic conditions. Do you think rates are going to go lower than expected, or are we in for a surprise? Drop your predictions in the comments. I'd love to hear your take. The recent surge in mortgage rates following the Fed's aggressive rate hikes in 2022 shows how mortgage rates can respond to broader economic signals, even if they don't mirror the Fed's moves exactly. Analyzing both the federal funds rate and mortgage rate trends can offer homebuyers valuable insights into potential changes in borrowing costs. Interestingly, the last time the federal funds rate was this high was in 2007, just before the financial crisis began to unfold. Back then, the Fed's interest rate was significantly higher compared to the near-zero rates that followed the crisis. This historical context provides valuable insight into the current rate environment and underscores how the Fed's monetary policy can dramatically impact the economy over time. Understanding the dynamic between Fed interest rates and mortgage rates is crucial for homebuyers looking to time their purchases and secure better mortgage deals. By monitoring the Fed's decisions and analyzing the broader economic conditions, homebuyers can anticipate changes in mortgage rates and make more informed decisions. For instance, if the Fed is expected to lower interest rates, homebuyers may want to accelerate their home purchase, taking advantage of lower borrowing costs. It's important to remember that while Fed interest rates are a significant factor, they're not the only consideration. Analyzing broader economic conditions is essential, as there have been instances where mortgage rates have moved in the opposite direction of federal. The graph illustrates these variations, highlighting the need for a comprehensive approach when evaluating mortgage decisions. By considering both Fed actions and overall economic trends, home buyers can better navigate the complexities of securing favorable mortgage rates. To effectively speculate on mortgage rates, it's crucial to consider several key factors beyond just the Fed's interest rates. Here are some steps to help you anticipate future movements in mortgage rates. 1. Monitor economic indicators. Keep an eye on important economic indicators such as inflation rates, employment data, and GDP growth. High inflation can prompt the Fed to raise rates, which might lead to higher mortgage rates. Conversely, a strong economy with low inflation could keep mortgage rates stable or even lower them. Second, track Fed announcements. Pay close attention to statements and meeting minutes from the Federal Reserve. These can provide insights into the Fed's future plans and how they might impact interest rates. The Fed's guidance on monetary policy and their outlook on economic conditions can offer clues about potential rate changes. Follow market trends. Observe trends in the bond market, as they often influence mortgage rates. When bond yields rise, mortgage rates typically follow. Similarly, a decrease in yields can lead to lower mortgage rates. Consider global events. Global economic conditions and geopolitical events can also impact mortgage rates. Economic instability or significant global events may lead to changes in interest rates as investors seek safe haven assets or react to international economic trends. 5. Consult financial experts. Engage with financial advisors or mortgage brokers who can provide expert analysis and forecasts. They can offer personalized advice based on current market conditions and help you make informed decisions about timing your mortgage application. By integrating these strategies into your approach, you can gain a clearer understanding of how mortgage rates might move and make more strategic decisions when it comes to home financing. Remember, while it's impossible to predict rates with absolute certainty, staying informed and proactive can significantly improve your chances of securing favorable mortgage terms. While monitoring economic indicators, Fed announcements, and market trends might seem daunting at first, it's more manageable than it appears. In my upcoming video, I'll walk you through these processes step by step, making it easier for you to stay informed and seize the best opportunities to lock in favorable mortgage rates. Making it easier for you to stay informed and seize the best opportunities to lock in favorable mortgage rates. To ensure you don't miss this valuable guide, be sure to subscribe to the channel and hit the notification bell. This way, you'll be alerted as soon as the video is available. I'd love to hear your thoughts on this topic in the comments below. In my next video, I'll break down how to use economic indicators in real time to make better mortgage decisions, helping you navigate the complexities with confidence. Thank you for watching.